Today, first we'll go over a little bit of a recap, as we always do, of what we talked about previously. So last time we talked about some different account types that you might run into, your qualified and non-qualified. And after doing a little bit more digging into the terms qualified and non-qualified, we use them in a little bit more broad strokes of a fashion. But if you hear somebody say the words qualified plan, that refers to something much more specifically, and that is actually a retirement plan provided by an employer that gets the tax benefits. So that would actually not include your IRAs of any type, and would only be your ESOP, profit sharing, 401 and 403 and all that type of stuff. But anyway, we also talked about your different non-qualified accounts, like all your individual, trust and estate, all of the other non-qualified, no tax benefit accounts that you might run into. We talked about the different popular investment vehicles that you might see inside your investment accounts or see offered in many different types of investment accounts, all the way from stocks, bonds, to all the different types of funds and some non-publicly traded and non-favorable investments like annuities. We talked about some different things that funds might do inside of their asset pool, like index funds that might track a particular list on a very low management basis in that category of passively managed, which could also include other sectors, or bond portfolios as well, where they might hold those bonds all the way through maturity. Actively managed funds, things like your actively managed growth funds, other things of that sort. And we compared mutual funds and ETFs to kind of see what the differences were between those two. So in our mutual funds, as we talked about, those trade in the primary market. That's where you having a transaction straight with the mutual fund company, even if it's through your brokerage account. Mutual funds will distribute their capital gains, usually a lot of the times towards the end of the year. Sometimes it can be more frequent than that, but a lot of the times it'll be annual. There's no intraday trading, so you can't buy in the morning, sell in the afternoon, or anything of the sort like that. You've got to wait for your trade to settle at the end of the day. You can have exact dollar amount holdings, so every dollar that you put in, that reflects your held value. You don't really have any concern of volume in the market or availability, because the counterparty to your trade is the mutual fund company and not somebody else who wants to buy or sell. They are obligated to fulfill that transaction for you. In terms of ETFs, those trade on the secondary market, like we discussed. You're buying and selling those from some other trader or market maker, or even from the mutual fund company if it's an IPO. They're generally tax advantaged for the most part. Again, caveat, it's possible that there are capital gains distributions. I don't think I've ever seen that in my experience with ETFs. But of course, they can kick out a little bit of yield in the form of dividends, as a lot of other things can. You can intraday trade ETFs, go back and forth. You could day trade them if you really want to, buy and sell options on them. A lot of people buy and sell options on index fund ETFs. You have to buy them in whole shares unless you're with one of those brokers that lets you buy and sell fractional shares, but that's not really something that we cover too much. But for the most part, you'll have whole shares. And there's the possibility that you might have high spread or just low trading volume on those assets. So usually it's not too much of a concern for an individual investor, but it is possible that you might have a decent amount of spread between the bid and the ask on these.
Did you make a comment maybe at the very first class that are moving toward becoming ETFs?
So commonly, there's a lot of the big companies are making that switch just simply because there's not a whole lot of benefit to keep a mutual fund as a mutual fund and not an ETF. There are a lot of companies who aren't changing, so it's not really a whole industry-wide thing that it's known that all mutual funds are moving to ETFs, but there are some conversions happening.
Okay, you say it's not a benefit to keep it as a mutual fund. It's not a benefit to them, or it's not a benefit to us?
Just as a product offered to a customer. So for us, there's really no, at least
meaning you as a broker, or
us as customers
okay.
of the product. Yeah, us as investors. So the really only benefit that I could see with a mutual fund is that I don't have to buy in whole shares. That's pretty much all that I can see. If there were really intense expense differences, but even then, I can find ETFs really cheap. I can find mutual funds really cheap, so that's not really a concern. But the only two things really that I would want to have a mutual fund for is the fact that I can invest whole dollars no matter what, don't have to have a whole share, and that there's no volume concern. So that mostly applies to us as professionals because we're dealing in larger quantities. So then at that point, then I might want a mutual fund because I don't have to worry about price going up and down, affecting the market on too much of a crazy level. I'm just, that transaction's getting fulfilled no matter what. But for the most part.
The mutual fund company is that they make a higher fee expense ratio on a whole mutual fund that nobody has complained about yet. So they might still keep the mutual funds around. The management fee could be 0.75, 0.65, and if they can keep money there, their fee is higher. But the benefit to us, to an exchange traded fund, is the competition, and that a lot of money goes in there very quickly. So a company that only managed 100 million could probably raise 500 million in an exchange traded fund because the fee's lower, so it's more attractive. So for the companies to go to ETF, they don't want to lose market share, so they're going where the market is in the exchange traded funds. That benefits them. Plus, they just create the funds, sell the shares. They don't have to do all the administrative stuff behind the scenes. So they could benefit administratively, but the big benefit is they keep up with the popularity of the ETF and not lose business. The benefit to us is you can buy and sell the exchange traded fund usually more tax efficiently than the old mutual fund, and hopefully the fees might be lower.
Yeah, something to keep in mind is it's not necessarily true that an ETF is cheaper than a mutual fund. There's a lot of mutual funds out there that are more like a few basis points, whereas plenty of ETFs on the same index that might be 10 or 20. For example, the two really popular ETFs right now, SPY and QQQ, actually tend to have a little higher expense ratios, closer to the 20 basis point mark, especially at least for SPY. But you can find mutual funds that trade at a much lower level than that, closer to 5 basis points. So it really just depends on the individual investment. But again, like you mentioned, the market is going towards ETFs because they're simply the better product for investors.
We call them exchange traded mutual funds. That's pretty much all they are. But with the competition and their expenses being lower, they can reduce their fees.
Yeah. So we also talked about some market indices, the major 3 and some additional ones. So we went over our Standard & Poor's, Dow Jones, and NASDAQ, stuff you've commonly heard of and things that you'll often find in your portfolios. And today we're going to start talking about how you're actually going to begin constructing new portfolios. And for the most part, we're going to talk conceptually. We're going to go kind of over the broad strokes and give you an idea of the things that you're going to use as reasoning when you're choosing your investments. And as we move forward into later classes, we'll start delving into the actual analytics and the statistics that you'll use in order to evaluate different funds to fill these spots in your portfolio. So to start with, I like to call this new portfolio construction theory because it's a combination of a lot of different things that both we've seen in the market, things that have been researched and vetted for many years and decades. And really what this is they're concepts derived from modern portfolio theory, which we'll discuss in a later class more in detail, and our experience in the markets. This is really our basis for how we're selecting investments and how we're building portfolios. And it's really just a guideline to simplify this whole process, because you could spend hours and hours and days going through all the little nitty-gritty and creating these perfectly efficient portfolios. But at the end of the day, for an individual investor, I think it's important to simplify things as a starting point, and then you can begin to compound your knowledge on top of that. So there's 2 categories that we look at when we're building portfolios, and we have named them lateral integration and vertical integration. To start with, lateral integration really is looking at the horizontal axis. We're using time as our measurement for how much risk we can take. Obviously, there is also the dollar amount that we're looking for, but the amount of time that we have gives us a barometer on how risky we can go. The longer amount of time that we have, the higher our risk tolerance can be, and the shorter amount of time that we have, the lower the risk tolerance needs to be for our certainty of success to be high. So really all of this, what's happening is with these factors is when you're pushing further out or closer in, the thing that you're ultimately affecting is your chance of success. There is always a chance that you could put your entire portfolio into Apple stock today and it doubles tomorrow. But there's also completely a chance that it could cut in half for whatever reason, and that's the risk that you take. So it's balancing all of these different factors to give you a high probability of success in the future. Vertical integration is basically looking at your account from the bottom up and from the top down. What we're talking about is diversification and exposure to different things in the market. Generally, what we're doing is if we have a high level of risk tolerance that we can take and we're going into a lot of equities, what we also want to do is spread out between a lot of different equities. Like I mentioned, we might have a lot of time, but we're still not going to pick one individual stock for the most part. High risk that that particular company could be the one that goes out of business before we make it to our end goal. So we want to diversify those types of risks and get them out of our portfolio so that the only risk that we're really taking is market risk. And we'll dive into these concepts a little bit more in just a second. So kind of going over what I just talked about with time. When we're using time to select our investments, the longer we have, the more risk we can take. And we'll justify that in just a moment. The stronger our liquidity needs are, so our need for cash, our need for spendable capital, the less risk we can actually take. Because if we are needing cash in the next year, in the next 2 years, 3, 4, 5, we can't take so much risk that puts those cash expenditures or distributions at risk. We want those to be safe and provided for in the event that we need to take that liquidity. So creating a portfolio mostly is a balance of these two factors, of our liquidity and our time horizon. Those are the main two things that are going to be important, because you could really forego a lot of the vertical integration and just look at an index equity fund and an index bond fund and use this concept here to create a portfolio that gives you a majority of the probability for success that we are creating when we build portfolios. So let's look at an example of what liquidity might be. Let's say we're looking at purchasing a house and we need to put $100,000 down. $500,000 house, 20% down payment, normal stuff. So if we have our first investment, we have in the time period when this down payment comes due, we have a 95% chance of returning 3%. Or we have a 5% chance of returning 1% or losing 1%. That seems pretty safe to me, and that would be a comfortable place to park my $100,000. But if we have another investment that has a 50% chance of returning $100,000 and a 50% chance of returning negative 50%, or yeah, 100% or negative 50, there are some people who will get so caught up in this right here that they're willing to take on that risk. But then what happens when we get to when the purchase happens, and we had that big chance of losing capital, and now we have half the capital and we can't supply our need. That's why we have to make sure that we have the proper amount of time and the proper amount of risk aligned with our objectives. Because if they're not aligned and we take this investment and we do actually lose 50% of our capital, we're not able to go through with the purchase of the house that we were expecting. And that might create a lot of drama in your family. So looking at this more guaranteed investment, nothing's a guarantee, but this kind of investment might be something like a money market fund. It's not high return, but it's not high risk. It's something you put your capital in, usually to sit in and just generate a little bit of interest while we're waiting for another purpose in the future. To justify the idea that time reduces our overall risk, here's a slide from Morningstar, from a Morningstar presentation, and each of these different colors here are different assets. Over on the right here, we have our treasury bills. So you'll have your short-term treasury bills here. Longer-term government bonds, things like 5-10-year sort of bonds. You've got your large stocks, so that's your large cap blue chips and stuff like that, and your small stocks. And each of the different bars represent different time frames, starting on the left from 1 year, in the middle is 5 year, and on the right is 20 year. So if we look at large stocks here, which are super common, that's the thing you'll find in your investment accounts a lot of the time. That's your index funds and things like that. When we just have 1 year of exposure to that asset class, we can see that there is, yes, a decent amount of chance to get a 60% return or something like that. But we also have this big chance of dropping in value, because when you have an investment like this, each year can be radically different, but they tend to average out to something predictable. So when you only have 1 year of data, you have a lot of areas that you can go. But if we move over towards 5 years, you can see that the risk is actually reduced by a dramatic margin, and we're getting much closer to a stable sort of idea of the future. And in 20 years, you can see that that number has reduced dramatically from 1 year. So holding large stocks over 20 years actually reduces the risk profile by such an incredible magnitude that it's almost considered a stable investment at that point. And you can see the same thing even with small stocks, where the risk on the first year is absolutely insane, but so is the return. So you could have a horrible year or you could have an amazing year. But then when everything starts to average out, we get a much tighter grouping of returns. Yes?
So what is the return then on a 20-year stock investment?
That's going to totally depend. I mean, you can't really say for certain across the board what that's going to be. But if we look at, because we can't predict forward. We can only look backward at historical data and use that as a guideline. So generally, yeah, something like the S&P, yeah, that would be somewhere between the realm of 8 to 12 is kind of how it's kind of up and down from there. So, but again, you won't see that on an individual year basis. You'll see that on the decades averaged out over time.
Yeah, it's hard to realize that the S&Ps, I think the last 10-year average I saw was only 11%, but this last year, but they're up 25%. Well, the year before they were down 30-something, and they're mostly tech stocks, and so that's why these averages in the upper right-hand corner are not averages, other than at the end of 20 years, we average the ups and the downs.
Yeah, and it's something to also think about is when you see these average returns, you'll see something called compound annual return. So that's not actually a simple average. That's not taking each individual year and flat averaging it out as you would with just a regular calculation. That's more calculating if you earn 10% 1 year and then you earn 10% on that and then 10% on that, it's compounding on top of itself over time. So these returns might look a little lower than what you would expect if you just added up the difference in value and divided it by years. But again, you kind of have to think about it like if you had your money in a savings account, you earned 1%, you're now going to earn more interest on your original capital plus the interest you earned in that year.
And look at the average on the small caps is 11.8, which is almost 2% more than large. But look at the volatility.
Yeah.
And I'm going to guess volatility. Large caps have a history of standard deviation about 17% on average, up or down. I don't know what the calculation means. You can explain what standard deviation means later. But the small caps have a volatility not 17, but 35%.
Yeah.
So it's not worth it in the short term, but it could be in the long term. What's that one again?
This one here?
Yeah.
This is long-term government bonds. Yeah.
I was just looking at the 20-year for all of them, and there's not a lot of difference between the small cap and the mid and large cap. Right?
Yeah.
And everything else, but
Yeah, correct. You will notice that when you get on these super long-term investments for a lot of the time, they actually become very similar, but also something to keep in mind is just because of how compressed those values are because of how wide this one reaches. So that could also be kind of part of just, we don't have all the exact numbers of all of these here. So I think that the presentation kind of skews it a little bit.
And he'll show you a 50-year chart, which will, small caps will blow themselves off the chart. But in the short term, they're very volatile.
Yeah, and something about standard deviation, we'll talk about this more in depth, but just as a little reminder, when you hear standard deviation, people will think I could either gain 15% or lose 15%.
That's what I thought.
But really what it means is it's how much you can deviate from the average expected return. So if I have an expected return of 12% and a standard deviation of 5, I could gain 12% or I could gain 17 or I could gain 7 is the most reasonable sort of, those are the averages that we're expecting based on standard deviation. Obviously, you can have negative returns and you can have way more positive, but generally it's kind of kept in that channel in terms of compound averages. So to kind of justify some more, law of large numbers is a concept that really does apply to investment returns. And I'll just read the definition. Don't worry about understanding it right away. We'll explain it in just a second. But the definition is, as the sample size grows, its mean gets closer and closer to the average of the whole population. In simple terms, what this means is if I'm looking at data for 100,000 different things, I will have an average measurement. If I look at all of the different measurements of those, let's say returns, if I have 100 different years of returns, I can come up with a 7% compound annual return. But the fewer and fewer years that I start to look at, the further we start to stray from that average. Because the numbers can be so different, if I'm looking at a population of 100, but then I only look at 2, I might have a 30% return and a negative 50% return. And that wouldn't make any sense because it wouldn't average out to our average. But the more we start to add in data, the closer and closer the average of what I'm looking at starts to represent the total data. So again, if I'm looking at 100 years of Dow performance, the more years I start to add on to how long I've been invested, the closer my returns are going to look to what has been the measured average over that time. So if I'm only invested for 3 years, it's very, very possible my returns are not going to look anything like what we've been measuring over the last century. So insurance companies use this for risk mitigation. This is how insurance really works, because if I know what the risk is on a certain type of driver, but I only insure 2 drivers, my risk is really high because I'm only collecting a little bit of insurance premiums for 2 people who could basically catastrophically destroy my business, which is why I would want to take on more and more people of that same risk level so that as an average, I start to outweigh that risk by having so many people that are less likely to have an accident that when I have that small percentage of people that do, everybody else's premiums pay for that. More similar policyholders equals less statistical risk. So it wouldn't make any sense if I take all different kinds of policyholders, people who have a really high risk and just a ton of those. But if I have a lot of people that have a similar amount of risk per individual, the more of those I have, the less chance I have that everybody is going to have an accident and bankrupt me. So let's look at that with investing using the Dow Jones like I was just mentioning. The Dow Jones Index had average returns of about 8%, 8.7% from 1998 all the way to 2022. And this was measured using the SPDR Dow Jones Industrial ETF, DIA. So that's an ETF that tracks the index. There's a lot of them out there, but this is the one that I had the data for. So if we look at the different years, this shows from 2012 to 2021, we can see a lot of difference in the returns. You can see that there's years of 27%. That's not very close to 8.7. There's a 24, 20, 28.7%. But at the same time, we can see that there are negative returns, like negative 4%, negative 0.53%, some 9%, and there's a lot of data there that is very different from that average of 8.7. There are some that are close, but there are a lot that are far away. So if I'm only participating right here, I would say, are you kidding me? The Dow Jones performs way better than 8.7% a year. I made 28.7% in 2013. But then if I start to get more and more of that data, we start getting some of these lower values like negative 0.53, negative 4, and probably some more 2 and 3% return years. Those start to bring my average closer and closer to what we've been seeing over this long period of time that we measure. So what do we do with this data? How do we use this to our advantage? Well, what we want to do is we want to hold the riskier assets, things that have a higher standard deviation, things that go up and down more frequently and more drastically. We want to hold them for a longer period of time, because what we want to do is we want to participate in them long enough that our returns actually gravitate towards their average. We don't want to be in just a little period of time and lose a bunch of money and then go, stock market isn't for me. We want to actually make sure that we're in that asset for long enough that statistically we are going to feel similar returns as to what has been measured over time. And then we'll want to use less risky assets for immediate needs. Money market funds, treasury bills. We don't want to be putting immediate needs into assets that need 20 years for us to get the proper data. We want to put them in things that we know are not going to be flying up and down in value and that we're able to liquidate easily and use for whatever that purpose is. Additionally, we'll diversify. One of the other advantages of diversification is the fact that you can have some similar assets that perform very differently. You might have a particular stock that has a really bad year. Even if over the 10 years, 20 years, 30 years, it's going to be fine, you might have a really bad year with one stock. But you might have another stock that does particularly good that year. And the other thing that that does is also help bring your returns closer to that average. So the diversification can help you not feel a particular bad egg as much, though you will be giving up some of that upside potential on that individual stock. Another thing that we can do to help out is something called dollar cost averaging. What dollar cost averaging is, you're probably familiar with it, is investing flat amounts at regular intervals regardless of what price the asset, stock, bond, whatever it is, regardless of what the price is. What this ends up doing is, without you thinking about it, you end up buying more cheaper shares and less expensive shares. If we're in a market that just goes up forever, sure, you might not get as many shares as you want and you're buying less and less of them. But in a market that is volatile, when buying opportunities present themselves, you will take advantage of them without having to try. So dollar cost averaging is primarily a risk mitigation tool, and the risk that you're mitigating for the most part is buying everything in a flat amount immediately and then the stock market drops. What you want to be doing is buy a little bit and then it drops and you buy a bunch more shares, starts coming back up. Okay, I don't get quite as many shares, but you just keep putting in that amount over time. This is exactly how I put clients into positions. I'm not going to sell off $100,000 of a mutual fund and then immediately go buy $100,000 of the ETF that I want. I want to go in over time, even if it's a shorter time period. I still want to go step by step and let the market kind of tell me what my cost basis is going to be rather than just deciding it one day. So looking at dollar cost averaging, the advantage is over time, this system could keep the average cost of shares low because, like I mentioned, when prices are lower, you end up buying more. Purchasing power has potential to be more efficient without the need for tracking share price or waiting for it to drop. This doesn't require a lot of activity from you. It's a very easy thing to implement, and you don't really have the stress of knowing whether you made the right decision or not, because you know over the long term it will end up panning out. So these graphs are a little difficult to see, but we'll look at this in a bear market versus a bull market and see what happens when you invest $250 a month for a year in both up and down markets. So here we have this line of the share price kind of going up and down over time. And if we're investing $250 every month on each of these periods, we can see that as the price begins to go down, we're going to get more of those shares. And that average actually ends up being held pretty close to what the share price is here, versus if you had purchased all of your shares at this price and the bear market continues, you would be at a net loss. But if you continue purchasing in these lower cost environments, your cost basis rises up right about to where the share price is. And a similar thing can happen in a bull market, where your average price tends to lag behind that of the current price. Because again, as the prices drop in short-term price fluctuations, you're going to be buying more shares. In the bearish example, you can see that you purchased 102 shares with an average share price of $29.30. And in the bull market, you bought 46 shares at an average of $64.62. So that's one of those tools that you can use. So here again, you can see some results from dollar cost averaging, where you have different prices at different times. And you can see that when you invest the same flat dollar amount, you'll get more shares. So for Boris's strategy, which was the buy and hold, put all of the money in at once and hold it until the end, he bought $400 worth of stock at $10 a share and got 40 shares. We went down to $5, went down to $2, came back up to $10, and he didn't realize any gain. He's still flat on the position. Versus Abby. Abby takes her $400 and she splits it over 4 different purchases. Initially, she gets 10 of the $10 shares for $100. And then on the next period, she gets to buy 20 shares because the price has dropped to $5. And then when the price drops again to $2, she can buy 50 shares. And so this means when the price jumps back up to $10, She's got 90 shares versus Boris's 40, which ends up being a value of $dollars versus 400. Obviously, this assumes that the stock price comes back, and if the price action is only bearish for the rest of time, you're probably not going to feel a lot of benefit. But in a volatile stock market, dollar cost averaging is a very easy way to bring your cost basis down over time. So, looking at time-based asset allocation, which is our most basic form of our portfolio building, generally, in most scenarios, obviously this can change, but generally, your ultra short-term needs, anything that's immediate, probably the next 5 years, you're going to stick in, for the most part, cash or very short-term bonds, but cash is the safest place to put it. When you're looking at intermediate term, that might someday be converted into cash, but is not needed at this current time, you probably will put it into a bond, some kind of debt instrument that's going to remain relatively stable but generate some interest during that time. When we're looking at the long term, many years out in the future, lots of time to build up the data and get the averages, that's when we start buying our stocks. These things can change based on the risk tolerance of the person, how long we really have, because if the money is not even going to be touched for another 40 years, I don't think I'd want to have any cash in there because it's not going to be funding anything. We want to put that into your stock portfolio so that it has that time to grow. So something that can help us sort of visualize this again, this time-based asset allocation, is this risk tolerance spectrum from Morningstar. This really is just showing the amount of risk that a different category of asset might have. So all the way at the top, high risk, highest potential return, we have our small stocks like we discussed before. Small capitalization, small companies that haven't really done a whole lot yet and they're still working up. And then below that, we have our international stocks, then our large stocks, then our corporate bonds, and then our government bonds, and then our cash alternatives. So you can see sort of our three different categories sitting here. You can see the cash that we would want to use for our immediate needs because it has such low risk, and even though it has low return. And government bonds, short-term government bonds might be where we start to stretch that out. Then as we get to corporate bonds and longer-term government bonds, that's where we might be using that intermediate term for that because we are taking a little bit more risk, but we aren't taking a whole lot of risk. And then as we move to the stocks, from large international to small, that's when we're going to want to be using those long time frames to get all of that data, to get all of those returns to compound over time. So now that we've finished with time, the next thing that we're going to talk about is diversification. Diversification is pretty much the process of minimizing exposure to any single risk by combining multiple assets of different types and exposure in a portfolio. So in simple terms, what we're looking at is if I have a holding in an individual stock, again, let's say it's Apple, and if for some reason nobody wants to buy an iPhone anymore, the Apple stock probably isn't going to be doing as well. It's probably going to start trending downwards. They're going to start losing market share. Maybe they have really bad management. They make a horrendous advertising mistake or something like that. Say they just start going downhill. If all I own is Apple, regardless if my risk tolerance says I can invest in all stock, if all I own is Apple and Apple burns to the ground, I still will have no money left at the end of the day. So what I'm going to do to mitigate that risk is I'm going to purchase other similar securities, other similar assets that give me a similar risk to return profile that are different companies. So if I now own two companies, if I have Apple and Microsoft, it's likely that where Apple fails, Microsoft probably will hold their own or try to compete and possibly do well. And if I add another company, I add Google, I have more diversification and less chance for failure because they're differing management teams and they're different finances, different companies, and we're spreading ourselves between these. Now I have much lower risk, albeit still a high risk, that if one company goes under, I only lose a third of my money. But that's not good enough for me. So I begin adding more and more companies, not just tech stocks, but more stocks that give me a similar idea of risk to return, usually in stuff like mutual funds, index funds, ETFs, and the like. And the more and more I get spread out, the less and less that risk starts to affect me to where it just kind of disappears. And we'll talk about those individual risks a little more in a second. But really, I just want to not take so much risk with one asset that is more than my market risk. If I'm already taking so much risk by going 100% in stocks, I don't want to add additional risks of a company failing on top of that. And you can see here basically what I'm talking about, where you will have two different colors. The top is your company risk, and the bottom is market risk. And you can see that no matter how many stocks we have, the market risk we have stays the same, because it's the same kind of asset, it's the same level of risk for the same level of return. So we're taking on the same level of risk for dollars-wise in terms of the market, but you'll notice that the top company risk is most high with one individual stock and dwindles down to almost unnoticeable with 1,000 stocks in the portfolio. Again, the reasoning for this, like I just talked about, is because each company has inherent with it its own risks, which we'll label and identify in just a second. So the more different companies that you have in your portfolio, the less risk you have that any of those individual companies will have a catastrophic failure, taking your portfolio down with it. So types of risk. Let's talk about a couple different types of risk, and we'll go for some brief definitions of these. When we're looking at systematic risk, that's going to be our non-diversifiable, things that you can't get rid of, stuff that's going to stay regardless, and the only thing you can really do is manage it and adjust how much you're exposed to it. Purchasing power just has to do with how bad inflation gets. We can manage this, but we can't make it go away. Even if we invest in all stocks, sure, we can get a return that probably will outpace, but there's still always a chance that our stocks do not follow inflation, that we still can lose on the way. Reinvestment rate, it's possible that what we get into is not the best possible investment and something else generates a better return for the given level of risk, and we lose out on that amount of difference. However, if my allocations are still properly within my plan, that's not something I'm too concerned about. Interest rate risk, when you're in bonds, interest rate is something you can't control. It's something that only the Fed will control and bring up and down at their discretion. And depending on how long your bonds last, how long the maturity and duration are on those, that will determine your sort of sensitivity to that. Again, it's not something that we can make go away while still holding those bonds, but it is something that we can reduce by a very good margin by controlling how exposed we are to that sort of thing. And then market risk. The easy way to describe market risk, it's the risk that stuff goes up and down. It's just kind of what happens in the stock market. Stocks will go up, stocks will go down. That's the whole game we're playing. And exchange rate risk. If you're in a foreign investment, there's always the risk that the exchange rates can get wildly different, and then when you need to convert those assets to dollars, or simply the value calculated goes down because the dollar gets weaker and weaker, etc. Unsystematic risk is the type of thing that we can diversify away almost entirely. I say almost, but you can really get it to such a level that each individual investment is so small that it's not even going to be a noticeable difference in your portfolio. So the different kinds of unsystematic risk that we're looking at are accounting, and a lot of that has to do, I think it's very similar to financial, where it's really about the financial problems within the company and whether they are honest about their reporting or they're good at their finances. If a company just simply has horrible credit and starts defaulting on loans, it's pretty expected that that share price is going to start to tank. In terms of business, they can make a horrible business decision. They can invest in completely the wrong product. They can invest in completely the wrong other companies, and they could just take a turn for the worse. Like I mentioned with Apple, if for some reason nobody wants an iPhone anymore, that's not going to be the best result for Apple. You have country risk. So for each individual foreign country that you're in, there's a risk that something particular to that country could go really wrong. If I'm owning a German stock and something really bad goes down with Germany, that would be pretty bad. But if I own a diversified international fund, it's possible I have some exposure to Germany, but it could be counteracted by exposure that I have to Japan and China and Russia or whatever other companies or countries you could be thinking of. Executive risk, mostly has to do with the idea of the people at the very top making the worst possible decisions for the company. So if you bring in a CEO that doesn't know anything about iPhones and starts to just completely change the product, again, sort of related to business risk, a lot of these are very similar. Things could go south. And government and regulatory. Another one of those things, these, you'll most commonly run into this sort of thing with something like a municipal bond, where if I'm holding all California municipal bonds and California's finances just go completely kaput, that can mean really bad things for my municipal bonds. That can mean default rates and all sorts of things. But if I had been diversified across many states, across many different government agencies, I probably wouldn't feel that nearly as much because I would have other ones that would hold steady while California fails. So how are we actually addressing these risks? We've kind of talked about it a few times, but when we're looking at systematic risk, things like market risk and other things that you just kind of feel for being in the market, most of that is managed by managing your exposure to them and allocating your positions correctly based on the amount of time that you have. Because again, when we're looking at market risk, that's where that time factor really comes into play. If I have 10 years, I'm willing to take a lot more risk than I am if I have 2. If I have 20 years, even more. So the more time I have left, the more I can allow these assets to do their thing, the more risk I can take on. And that's the most of what we're going to be doing for managing systematic risk. And unsystematic risk, what we're doing is we're breaking down our allocations. So we might have our equity and our bonds and our cash, but then we'll take a closer look at our equity, break it down into multiple different specific things so that each of them don't have such high individual risk, usually from a company standpoint or something else of the sort. So we're making sure that we're allocated properly based on time, and we're not taking too much risk for how much time we have, and we're breaking down our allocations so that we're not too individually in any one thing, in any one specific asset or company or country or anything of the sort. Managing unsystematic risk can take a couple different forms. And really what this is limiting your exposure to any one type of risk, like we've mentioned. All of the things like accounting, executive, and financial, most of that really just boils down to don't put all of your eggs in one basket or stock. Because all of those different risks have to do with individual companies. So if you have more than one individual company, immediately those risks begin to minimize. And the more and more companies that you have within your portfolio, the more those risks begin to go away. In terms of country, you want to diversify among foreign countries. I'm not a big fan of buying individual foreign stocks because it's just kind of hard to know other markets as well as we know our own. So I like to buy index funds, cheap things, let the other managers do the work for me. And usually the international funds are just to give us a little bit of different returns as compared to the US. In terms of default, be wary of suspiciously high interest rates and pay attention to credit rating. The more interest is paid on a debt, likely the more risk there is to you for that defaulting. Because if there was no risk at all, they'd pay you the minimum amount of return that you could get in the market, like a government bond, for example. It's pretty much considered guaranteed, but you're also getting a much lower rate of return than if you bought a really poorly rated company's bond, because they're saying, we know you can't trust us, so here's 10% a year. And it's entirely possible that within the next couple years, they completely default on the bond and they're not able to pay anything out to you. And government and regulatory, diversify among sectors. Government and regulatory risk can actually apply to equities as well as municipal bonds and the sort, because if you're in, let's say, oil drilling companies, it's possible that all of the locations that those companies drill in get completely banned and they're not able to drill in them anymore. And now suddenly those companies have no revenue and they have to completely change their strategy, and that could be good or bad for them. It's possible, we've seen a lot of ESG funds performing really poorly in the long term because they're simply unable to compete with a lot of the other ways that we produce energy in the United States. So it's possible that if regulations and other things start to favor those green companies, they will actually perform better than the other natural gas and coal companies that you see commonly. So getting diversified among those different sectors pulls you away from that risk. Managing systematic risk, again, For purchasing power, don't leave your cash in cash. Unless you need to use that cash, it's hard to leave it there, because if you're earning absolutely 0%, you are losing easily to inflation every year. Things like money market funds, it's still a cash instrument, but at least it pays you something for being there. Super short-term bonds can be a good way to get a little bit of interest while you're waiting to put that money towards something else. But unless you have a particular need for actual cash, a lot of the times you want to get into interest-bearing securities, albeit with very low risk, so that you're not risking that money. With reinvestment rate, when you've got good rates, lock them in. If you've got a really good interest rate, if interest rates are high, I know it's difficult to not want to wait until the next interest rate hike, or the next one, or the next one. But if you can get a really good rate on your money compared to historical averages, it's good to lock that in, because then when rates begin to go down, you will be the one benefiting by a lot. In terms of interest rates, you want to keep your duration low for the most part, unless you're willing to take on extra risk. That's something that we saw very commonly, as there was a lot of time during all the very drastic interest rate hikes. We kept the duration of our bonds really low. That means that we had super short term, like 1 year, 2 year, 3 year, maybe stretching to 5 or 6. But we really kept those durations low, so that when those interest rates kept spiking, we maybe saw 5% dips, 10% dips, where the rest of the market started to see minus 20, 30, 40% on those much longer bonds. And we'll go into a lot more detail about how duration works and how that is risky for you in the future. But really just know that the higher your duration is, the more risk you are subject to when it comes to interest rates moving up and down. Now, if your duration is high, that also means that if interest rates start to come down, you will be the one benefiting a lot, because people will be willing to pay more for those higher rate-bearing bonds. In terms of market risk, like we've mentioned several times, you want to allocate with time in mind. You want to allocate knowing at what point are these assets going to be needed, at what point are they going to be utilized, and how can we make sure to allow ourselves the proper amount of time for whatever asset we decide to get to those average returns, so that we can actually see a positive benefit. In terms of exchange rate, diversify among those foreign countries. Don't put too much in one individual country, because like I mentioned, if that country goes belly up, or they start doing a lot stronger and the interest rate starts to stretch and get much worse for you, that's a lot of risk that you'll be taking on. So we'll call back to this reduction of risk over time to really hammer in that point. So again, when we have lots and lots of time, when we have 20 years, all of the risk profiles really start to minimize and get down there. And this is how we're managing that systematic risk. That's really what this is. This is a measurement of systematic risk in these different portfolios, more specifically market risk. So you can see that the risk profile of these investments is the highest over the shortest time periods. Even for treasury bills, it's not very high, granted, but still, it still is higher than if you held it for 20. Well, I guess it's just a return, but in terms of bonds and large stocks and small stocks, the shorter you hold these assets, the more the market risk profile exaggerates. And the longer you hold them, the further it starts to come down and squeeze into a better risk profile for us in terms of our objectives. So let's go over a recap of everything that we talked about today. Firstly, we talked about our lateral integration. So using time, like we mentioned over and over again, using all that time that we have to adjust our risk tolerance up and down, see how much time we have left. And usually what that means is how much more we're putting into equities versus bonds. The more equities, the more risk. Using vertical integration, diversification of market exposure to get ourselves spread across assets and make sure that we're not taking too much individual risk from any given company. We talked about lateral integration and specificity and how our time horizon is dictating our level of risk. And there could be day-to-day positive and negative returns, but statistically, they will tend to average out to a positive expected outcome. So when we look at maybe the last month of returns on a given stock, it could be all the way up, it could be all the way down, and we could be flat for that amount of time. But as we start to pull the veil back and look at years and years and years, those tend to average higher, especially for indices and other sectors overall. Risk off for liquidity, risk on for growth. When I say things like risk on or risk off, it really just means risk on, going into stocks, going into equities. Risk off, going into interest-bearing investments, safer things, more reasonable flatline investments. So if we're going risk off for liquidity, that means we're taking money out of stocks and we're putting it into money markets, short-term bonds, things that will pay us interest for our time but aren't going to be going up and down in value a whole lot so that we can maintain that value. And if we're going risk on for growth, we're going into these equities expecting volatility, expecting negative days and positive days, but hoping for a general trend to go upwards over time. And looking at asset class returns, this breaks that down again. We can see from 1926 all the way to 2022, so this is the most data that we could possibly have here. We can see that for small stocks, we were seeing all the way down to a negative 58% return, but then all the way up to 143 with a compound of 11.8. So what does that really mean? It just shows that you can see up to 150% return. You can see up to a negative 50% return. But if you were to hold it for that entire period of time, you'd be looking at a compound return, an average return every year of just shy of 12. And then with large stocks, similar story but less drastic. You could see it run all the way up to 54. You could see it run all the way down to negative 43, but your compound stays around 10%. Now this begs the question, a lot of people might look at this and think, well, why wouldn't I always just put everything in small stocks? Again, that depends on how much time you have. So a lot of people will use their investment portfolios and say, well, all I really need to do is buy the S&P forever and ever, and I'm going to get the best returns. And that might be true if you have forever and you can put yourself in a capsule and wait 100 years, but a lot of people just don't have that time. A lot of people want to have a little bit more certainty of what's going to happen, and a lot of people have needs that they need to fund sooner than the next 50 years. So you'll want to keep that in mind when you're creating your allocations. Again, long-term bonds, everything's a similar story, just trending downwards. You could go up 40%, you could go down 26%, but you'll have an average compound of about 5.2. Intermediate term, similar. Compound is actually really close, but the volatility up and down is decently lower, with about 30% positive, about 9.5 negative. And then with treasury bills, you have a really small average compound return because you're not getting a lot of growth on those. It's mostly the yield that's compounding over time, but closer to a 3% compound annual return with a possible rise up to 15% and a possible down to negative 0.02%. And then we started to talk about vertical integration. So we started talking about systematic risk and the different factors there, how that's a non-diversifiable risk. It's not something that adding more stocks is going to take away. It's something that you manage with proper asset allocation and lateral integration, making sure that, again, all the time that you have is properly allocated between your different assets so that your riskiest assets have the time they need to actually see the returns that we're looking for, and that your less risky assets are giving your cash needs something to pull from. Unsystematic risk, we went over all of the different things that an individual company might face or some individual investment. That's diversifiable, security-specific risk. So usually these risks are specific to a certain company or specific to owning one company. And you can manage that with a broad selection of different securities. So even if all you did was buy one of everything, your systematic risk might be a little off, but you'll know that you're not going to be facing a whole lot of unsystematic risk because you have so many different companies that if one disappeared, it might be 0.1% of your portfolio or less. Again, looking at that diversification to hammer in that point, looking at how even as market risk stays the same, we can reduce company risk to almost nothing by adding 1,000 stocks in our portfolio. So again, that really speaks to the point that if you have even a 100% equity portfolio, you still have risks that you need to manage. You still need to pull that company risk down. so that we don't end up in that position of having one individual company stock crash and burn and wipe us out completely. So with that in mind, with everything that we've talked about, you've got any questions or comments, let me know.
Question.
Yes.
What are equities?
Those will be stocks for the most part.
Okay.
Yeah, pretty much your stocks and preferred stocks and things like that.
And then sometimes we get confused, mutual fund, index fund, ETF. Mutual fund, ETF are kind of on opposite ends. Index fund can be mutual funds or an ETF fund or both. And any fund, ETF or mutual fund, can be a mixture of anything. So you got to read the prospectus or the information because it can end up being something completely different than what you thought. And then which companies that basket these mutual funds, ETFs, or indexes on either area do you like to work with the most?
Generally, the stuff that we're working with the most would be Vanguard, Fidelity, iShares, a little bit of BlackRock here and there. There are some more names that I can't think of. Yeah, Schwab. There's another one that I'm trying to think of. Anyway, ProShares, different stuff like that. There's a lot of different big companies, but Vanguard and Fidelity, iShares, all those big names. That's what I like because their fees are always really low. They're really inexpensive to own.
Yeah, you're not going to have Vanguard with the new best thing. They don't have a Bitcoin, right? They're going to wait until there's a demand for it, it gets really big, then they walk in and take over the market because they're a big name and they do whatever it is that they're going to do big. But they don't have as many individualized, factor-based or semi-managed funds out there because they don't want to do the work. They want it to keep it mass index and low cost, although technically Vanguard has several managed funds, right?
Yeah, they do have some.
Yeah, and but the one nice thing about Vanguard is you know the price is low. But we don't want to put all our money with Vanguard and wake up tomorrow and find out they got hacked and you're not going to have access to the funds for 2 months or so. Because your brokerage company is a hub for the information in your brokerage account, but Vanguard has to deal with the stocks and their funds or ETFs and secure those, and Schwab secures it, Fidelity, and everybody in a different location. So if somebody got hacked big time, especially with AI coming out, we don't want all our eggs with one company. So Vanguard, Fidelity, Schwab, but iShares is actually the biggest provider of ETFs out there. They're backed by BlackRock. So they do have some lower costs, but even then, unless it's Vanguard, you've got to look at the expense ratio because you can find something like a Schwab, I'm thinking low cost, but they have old funds that have high cost. Yes?
It used to be that you would know by law they had to answer the exact percentage of what the cost was by asking for the total cost. Is that still true? That if I ask them, because there's so many things that can be hidden inside the different portfolios, the fees. Is that still true that if I ask for the
Yeah.
total?
Yeah, the SEC does a lot of work in trying to make sure everything's fully disclosed. And one of the pain in the neck is Morningstar has a thing where we combine all the funds. And now we got to go back and add the advisor fee in there to make sure that it comes with a true net result, which is fine. I don't mind, but they make you do it on each fund. Can we do it on the
They
whole
can do it on
portfolio?
every single fund, and for some reason you can't set it to 0 on things you don't charge them.
Okay, yes, yeah, 'cause if you have a portfolio and you have a need for cash coming up, then it's a good idea to put that money in cash or CDs or money market funds. So I had a client this week, she's got, I think $1 million or $2 million, and she's gonna cash out $800,000 over the next year or two to be able to do the house remodel. So then I'm glad I called her, how's the plan's going, she got the permit. So now we're selling all the equity, stock-related funds, converting those to, not the cash account because you won't earn anything, that's how Schwab and everybody makes their money, but it'll go there first. But then it'll go to money market funds that have low expense, high yield, probably 4.5%, and ultra short-term bonds, maybe 4.5%, but if rates fall, they'll hold them a little longer, short-term bond funds, and that's about it. I don't want to go out there and all of a sudden she needs the money and have it lose value, but you know how it is when you're building something, all of a sudden it doesn't get done for 6 weeks or 6 months, and so we need to lock in some yield. So that rebalancing the portfolio based on what Nash was talking about, we had a long-term portfolio objective, now it's intermediate to short-term, so we need to rebalance that into short-term cash instruments, short-term bonds, in order to maintain our ethical standards. And there's a lot of advisors out there, either brokers or advisors, that don't do that. You've run into that before, right?
Yeah, absolutely. I've run into a lot of situations where they'll just kind of have you fill out a form and then they'll use that as their basis for all their investments. But one thing that we really want to make sure that we're doing, and one thing that I hope you're doing and challenging your advisor to do, is reevaluate constantly. Make sure that any needs that you have are provided for, especially with things like cash. Make sure that if you're going to be taking distribution, make sure you have that. Or one of the situations I ran into, which shocked me most, was people who would sell positions in a taxable account and not reach out or make any contact about the tax consequences, and end up putting tens of thousands of dollars on a client's tax return for what could have been a simple 5-minute phone call. And that's the sort of thing you want to make sure you're up on. You want to make sure that you're following through. And even if that's going to happen, you want to make sure you know, and then you can plan for it and finance it. On the worst side, you can have the best year in the stock market and a lot of capital gains get distributed to you, but you don't have the cash to pay the taxes. So you either have to take it out of the account or figure out some other way.
Yeah, that's why we don't like mutual funds, because they can buy and sell internally, and if it's not part of the retirement plan, you're gonna get the tax bill at the end of the year. Now, bless their heart, maybe they did the right thing and got rid of the stock that then fell, but it still triggers the taxes for you. So we recommend, if possible, have mutual funds in your retirement plans, because then that movement of money won't affect you. And then outside of it, try to do tax efficient index funds or tax free or whatever you can. But at the end of the year, we'll go and look at tax harvesting. Maybe we have a client that came in and she has a big risk fund that has a lot of gain. Well, we'll look at, are there any funds that have a little loss that we can sell it, buy something similar, so keep that person in that type of fund, but take the loss, and then sell some of that high risk fund that we've been wanting to get rid of.
I have some investments with Vanguard with I'm still working on it's probably 7 months at work. So I called and I asked the clerk that answered the phone, and I asked, is this a mutual fund or an ETF? And they had no idea what I was talking about. Then I got busy and I didn't have time to follow through on. But so how do I handle that, making sure that I have an ETF instead of a mutual fund? And
In the short term, we're happy to just look it up and tell you. You can either call the office, you can email Nash, or stick around, or bring us a symbol or something, you can look it up. But that's the scary part about the companies. Vanguard's not in the advice business. They do have advisors they'll assign you to if you have a lot of money, and even they don't go real far.
Well, I don't think it was Vanguard, I think it was the people that the intermediaries.
Oh, really?
Yeah, that
Okay.
they have a transfer company and then they buy, the writing leads, and that it's predominantly Vanguard that I have within this one 403B. So,
Yeah.
I would think that they would have to tell you, I just, I got this.
Yeah, they're not withholding information, it's just and the
Oh,
person
they
that
had
you
no
talk
idea
to.
what I was talking about.
Yeah, you have to be licensed in the business to give any information or advice. We can give limited information, can you, if you're not licensed?
You can give general information.
General, yeah.
I just wanted to know if it was an
Okay.
ETF mutual fund.
So-
I didn't want advice, I
You can
just
actually,
wanted.
there's a little trick that you can use, so especially if you look under statements, if you have the symbol, I mean, obviously you can just look it up, but, yeah, so one little trick that you can use is if there's 5 letters, it's a mutual fund. If there's 4 or 3, it's an ETF.
5
That's
letters
within the symbol. So like if you see something like PRWAX,
Really?
because there's 5 letters, you know that's a mutual fund, and a lot of times they end with X. But if you have fewer letters than 5, it's a stock or an ETF.
Interesting.
Yeah, that's actually something I do, because I constantly am looking at what we're holding, so I'll download a spreadsheet and then kind of break everything into different columns by using Excel, and that's how I split them apart. Because I know that anything that's 5 digits, that's going to be my mutual fund, and then anything that's a giant string of numbers, my annuities.
Oh, I didn't know that.
Yeah.
Is that a fact or just a
Oh,
trend?
yeah.
Okay.
I have a follow-up to not putting all your eggs in one basket.
Yeah.
You were talking about trying not to have over Vanguard or except when you were talking about Vanguard funds, right? My question is carried over, if you have any concern about all eggs being in underwater on those bonds.
Yeah.
They had to mark them to market in their financials.
Yeah, just like San Jose.
They kind of out of business
Yeah.
at some point. So do you worry about that type of thing, or do you have, for your clients, I assume they're typically an all-in-one custodian, although the individual fund holders may be different families.
Yeah, the research I found is that the custodian has the information from the fund. So if something happens to the custodian, you've got your records and you can backtrack it.
You would, in theory, have the holdings with whoever.
Yeah, they're not fit. Yeah, the certificates and all that stuff.
Accounting for it,
Yeah,
essentially.
and even if Schwab went bankrupt, they had tons of assets to back it and a lot of insurance, and it's even safer than the banks. But we don't like to have it for one, because if one of them got hacked, it could take more time to get the
That's
assets.
the funds you're.
Yeah, the funds.
You're not concerned about everything being, the custodian being offshore.
No, because that's the hub of the information you can go and collect it. But we use a company called National Financial Services. However, that's basically Fidelity. Yeah, that it's an individual brokerage firm, so independent advisors can trade through there but not see the name Fidelity. It's in small print, but it's pretty much Fidelity. They're the biggest custodian of all of them.
Yeah, and additionally on top of that, it may not cover all things, but you will also have SIPC protection, Civic, which will cover up to $500,000 of investable securities. So that's usually if your brokerage firm collapses or something like that, that insurance policy will step in and provide for some of that, kind of like FIPC.
Yeah, but they all go, with Schwab and them, they'll cover you like 2 or 3 million. They buy additional insurance, so it goes far above and beyond. So you have huge diversity because the actual assets are there. But remember back in 2008 when we saw these companies, like insurance companies, oh, I'm gonna buy this annuity and they promised me this, they promised me that. But what if that insurance company goes belly up? That's like owning one bond with one corporation. If they go belly up, but no, there's California and all the states have insurance. They have insurance associations that will cover 80% of 300,000 or 250 if they survive it. It's like FDIC has like 2% of all the assets they insure in cash, 2%. That's why I'd rather use T-bills if you can. If you gotta buy individual CDs versus T-bills, get on treasurydirect.org, buy T-bills. I'm just saying, if things got that bad, you know, it would be really bad. So FDIC is always gonna be there because the American's gonna be there. But if the day of the Walking Dead comes, I'd rather try to get my money out of the treasury T-bills first because the CDs will be locked up like that San Jose bank. I'm not worried about CDs, don't worry about it, you have the coverage. But if you just said, I'm just gonna do worst case scenario, T-bills are a little bit better. And then the hub of Schwab is good for the most part, but yes, they, like these banks, counted on longer term bonds. We didn't. Why? Because you have an old guy in the room. I started in 1980 and I saw government bonds drop 50% in resale. Now, if you waited 30 years, they would pay you back. And we saw this 2 years ago. My experience, we avoided this. We saw government bonds drop 40% if you bought 30-year treasuries, and all of a sudden new ones came out at almost twice the yield. You're going to have to wait another 29 years at 2%, where new ones came out at 4 or 4.5. So we have that wisdom plus the youth blends in together.
So is now then a good time to buy T-bills?
I think it is, but I wouldn't ladder them like a 1 month, a 3 month, a 6 month, and out, because what if you change your mind and you need some short-term cash? We don't want you to get beat up. Nobody knows where interest rates are going, including the Fed. We all thought they would drop a lot. That's why the market took off. It's still holding its own, and there's trillions of uninvested money out there in money market funds. That's what they tell me in all the programs I watch. But if interest rates do stabilize and start to fall, you will have wished you locked it in. But rates aren't that high. Mortgage rates, oh no, they're at 7. Well, back in the early 80s, that was a joke because you were paying 12 and 13%. The fun thing about all this is we have no idea what's going to happen. So that's why you follow Nash's plan of short-term, intermediate, long-term positions, so you've always got money positioned there. And then we go beyond that. So with Vanguard, if you call them, great company, but you won't talk to somebody for 20 minutes. And then they're not allowed to give you advice unless they're a licensed advisor. So it's hard to get help from Fidelity, Schwab, or anybody. And then when they give you an advisor, they'll put you on a massive program of block trade, not a block trade, but baskets, right, of funds. And so somebody manages that fund that everybody's in, but it's not for you independently. Yesterday, we had a lady drop by, was it yesterday? Panera, a bag of pastries from Panera. I'm in on the phone. I come out and I go, wow, that's nice. And she left a gift card. And so she was very thankful of something we did. We do an annual review, if not more, and we go through the investments, the insurance, the estate planning, okay, how's your trust and all that stuff. Now here's the odd little questions. How old is your house? Should it be inspected? Because I was carried out of a burning building when I was a child. Want to make sure the insurance is right, the uninsured motorist. And do you have a panic alarm? And do you do life scanning? Do you have your doctor scan everything? Well, no, my doctor doesn't do that much. I'm doing it next Tuesday where you go to these life scan things and they scan everything. They found something with her. And now her doctor's running tests and oh my gosh. And had she not taken our advice, she wouldn't know this. I've had other clients get long-term care insurance, yes or no, travel insurance. I've had 2 clients that had to collect on their travel insurance because they had emergencies on the trip. And then that underinsured motorist we talked about. So we just plan for the worst case scenario. So if you've got a brokerage account that has Vanguard, Fidelity, Schwab, and several other companies, we feel a little better about that. Sooner or later, somebody will get hacked. The people will get their money back because there's records of it everywhere. And we're looking forward to the brokerage companies use blockchain. Someday the blockchain will help you out and help improve things like that. So, any other questions? Anything that is a little bit confusing? Yeah.
When you talked about dollar cost averages, are you maybe planning to go more? So I was just curious about, so even if it's a relatively short period of time, you have monies that needed to be invested as a so I was just wondering how you approach that. Does that mean, if the money's sitting there, everybody agrees with what is invested, do you do it weekly, or do you stretch quick? I just wonder how.
Yeah, so that kind of depends on the ultimate time frame of that investing, because also something I'll gather is how quickly does this person want to be in the position? Because generally, how that process would work is come up with a proposal for the end game portfolio, kind of where we're trying to get to. And go, this is the problem for you, we'll go through all the things, we agree to that, and we go, okay, great, we'll get started. And kind of ask them, how quickly are you comfortable getting into this? Because if I still have the same amount of time on the other side where I'm going for this, I could go all in day one. Obviously, it just might look bad for the first couple of years, or first year, or first couple of months. But generally, I like to ask, how quickly are you interested in getting into these? They might say 6 months to a year. So we'll just kind of take that time frame and split it up into something reasonable. Generally, for me, I like to enter positions once a month, maybe twice a month, if either opportunities present or it's a short time period that I'm looking at. But generally, once a month is kind of how we'll break that up for the most part of the average.
Yeah, you'll get your best long-term investment results if you invest all at once. But if we all do it all at once on a Thursday and Monday, the market's down 25%, it's, oh my gosh, what have I done? So we like to go in a little bit at a time to let you ease on in without panicking and thinking, what have you done to me? Because you have to ask yourself, if I invest and the market goes, if I don't invest, the market goes up, am I going to be more upset about missing out than if I do invest and the market tanks, right? So most of us are nest egg investors. We're not speculating. So if we can buy in over time, it gains our confidence, and maybe the market tanks again, maybe you accelerate the buy-ins. But we're coming from it from a human behaviors. We just don't want to put everything in risk, and then all of a sudden, oh my gosh, I went with this guy and I'm down 20%, you lost me. Because it's kind of like, how's the market doing? Well, the market's not doing anything. It's just how people relate to, do I want to get in or out? How it's like buying Bitcoin. Do you think it'll become more popular or less popular? So in the short term, the stock market is only speculation on human behavior of what you might think the market's going to do or what a stock does. The real result is long term, as Nash is talking about. So I could tell you, because some people believe the stock market is a really good buy right now. reported NVIDIA is a really good buy. It's only 30 times versus 60 times or whatever.
It just hit a $2 trillion market cap today, by the way.
Yeah, we wouldn't touch it, or I wouldn't, would you? It's already in all your funds, all your, you
What
know.
is it?
It's, they create computer chips, so they create a specific kind of computer chip that's very widely used in personal computers.
And once AI became popular or talked about more in the last year or two.
Yeah, they create the hardware that powers a lot of AI.
Yeah, and then all of a sudden, NVIDIA looks really good, but there's other times that it didn't. But AI is not new. Go back to your archives and watch, what was that, 2001? There's mind-blowing stuff in there that they're doing now that they were flat screen behind the seat, color flat screen while they're flying in space. This is 1968. Talking computers, and then we all know how. Remember how was going to kill these guys? So it's whatever trend. So I would say in the short term, be careful of trends. If something tanks a lot, if you think it's got a rebound, then you might consider buying that. Some of the basic rebounders would be utilities, energy, real estate. One of these days, real estate's a good buy. I don't know when that is. But you can just look at second chance opportunities when something of good quality hits the skids for a while. If we hold on to it long enough, that's pretty good. And then if you want a tech fund versus buying one stock like Nash is talking about, you can buy a fund that has 30 tech funds. And then if it tanks, just wait it out. Don't worry about it. But if you own one tech company, it could go under and you're gone. That's a problem. Any other questions? We have a test at the back of the book if you want to go on the test yourself. Right? And the funds that we see, there's so many different ones. How many stocks in average would be a Dow Jones Industrial Index fund hold? 30, because that's how many are in. And then how many stocks in the S&P 500 index fund? 500. 500? 503 or something. There's 3 extra stocks that have different, Google A, Google B, Google C. That's the one you can use at your cocktail parties. How many stocks are in the S&P 500? Oh, 500. No, that's wrong. Okay. And the other thing is, if you have some person that's got a lot of money and they're bragging about how much money they're making on CDs, then just ask them, why aren't you owning T-bills? Well, I own CDs. Well, what's the benefit of T-bills? No state tax. So if you're a rich person, what are you doing in CDs? You should be in T-bills getting the state tax rate.
However, what if you live in a tax-free state?
Then it wouldn't matter. Yeah, I talked to a client yesterday, she lives in Tennessee, so it wouldn't matter for her, as long as you've got FDIC insurance. But for some of us, and then is Social Security taxable?
Yes.
Depends on the state. Depends on how much you make. Is it state taxable?
Depends on the state.
Depends on the state. There you go. See, you guys are smart. California doesn't tax it, right? Social Security. No. So there's good things about California. They raised the protection on your house from 100 to 650 on the homestead. That's good. And does California charge a capital gains tax?
Gotta watch out.
After 2.
Yeah, well, they charge ordinary income pretty much. Yeah, depending on where you are. And then if you move out of your house, you have 250,000 gain plus the cost of the house at that point. Then the last thing, does California charge inheritance tax?
At a certain level.
They don't. Now, you want to be careful because if you move to Oregon or Washington, one of them has like I'm leaving California, go there, and you pass, the state's going to get inheritance tax on everything over probably $100,000, whereas California doesn't. So we'll recover with our mistakes and problems, but we have some pretty good little points here.
But the federal state tax is over a couple million, isn't it? It was
Federal
2
state
million?
tax?
Yeah, federal estate tax, you have a lifetime exemption, approximately $13 million. And so, one thing you can't chip away at that is if you're gifting more than the annual exclusion. So there's an annual exclusion you can gift to whoever you want. It's like $16,000 a year. And then if you go over that, you chip away from your lifetime exemption. And then when you get to the end, it's however much of that exemption you have left applies to your estate. then over that, you get to the really expensive estate tax.
You lost me, but that's okay, I don't think I have to worry
Yeah.
about it.
How do they know how much you're giving to your kids or whatever?
How is that?
They may or may not know, but if I won the lottery today and I got $30 million lottery and I net 15 million, let's say, I could walk out on the street and give as many different people $17,000, and all my money's gone, no estate tax. But if I give money to one person, everything over 13 million, from 13 to say 50, that last 2 million is gonna be 40% estate tax. Now, that 13 million, just because you wanna play the lottery, it's gonna drop back to about 6 million in a few years. Doesn't affect most of us, but it's gonna drop at that point. So there's little itty bitty things that we wanna learn about, but if you can give away $17,000 a year. And then I talked to another client, and here's the planning strategy. She has a 42-year-old son that's moving from up north with his 36-year-old wife down here. My client's kind of bummed out, a little depressed that they're not having children, right? That's her purpose. She wants to be a grandparent. And if he moves down here, the son's thinking, well, and the wife's having to go to work, we just gotta make money. Well, my client has oodles of money and just inherited a lot of money. So I said, well, why don't you hire your son, who's a home inspector, to manage the real estate? You can pay him big salary so the two of them don't have to worry about money. And if you're not worried about money as much, what might you wanna have?
Kids.
Kids, yay! She's like, wow.
People can do that.
Yeah,
They
yeah.
play those games, the
Well,
rest of
she
us
was
can't.
very lucky. She inherited a lot of money, and money she's like, doesn't even want it because it's too much responsibility. But if you can transfer it to working people, who knows? That's just a little game to play. It's just ideas. But that's why you want to consider the whole picture. My last bit of advice and ask you to do is pass this on. Whatever you learn here, pass it on to your adult children, friends, people down the street, because this lady that we got to go do the life screening, we might have saved her life. That's amazing. That makes it all worth it. So it's not like picking a big stock. Anybody can do that. You guys can do that. So, okay. See you next week. Grab some stuff up here if you want any extras.
Hey, welcome in.
Is 11 to 3 for the high school?